Hey everyone, welcome back to another episode of the Beyond MD podcast. To everyone who has signed up for and supported the Beyond MD newsletter, thank you. And to those of you who reached out to me after the most recent issue, which was the most popular to date, titled 5 Ways to Live a Happier and More Present Life, I can't thank you enough for the feedback and support. If you're interested in content at the intersection of personal finance and our personal well-being, I encourage you to check out the newsletter. You can register for it by visiting my website, beyondmd.ca, going to the newsletter tab, and then entering your email address. So today's interview is a different perspective on whole life insurance. And I understand that for some, this may be a bit of a controversial topic, but you all know me. I am curious and I like to explore different topics with an open mind. So for today's episode, I welcome Donny Mangos. Donny is a real estate investor who has turned into an expert in insurance and also an enthusiast in insurance. He does use whole life insurance for himself, and it is one of his key wealth building strategies. Now, a disclaimer here, Donny does build and optimize policies for other people, but he's keen on educating. But I brought him onto the show because he does a great job explaining these policies in a very easy to understand way. Now, my view is that whole life insurance, which is a type of permanent life insurance, this is not for everyone. But I also do not believe in extreme statements like all doctors should avoid whole life insurance and that whole life insurance is the holy grail. I do not believe in any of those things, but I do believe that any strategy can be the right fit for the right person in the right circumstances. So do not go and sign up for a policy just because you listen to this episode, but do explore topics with a curious mind and ask all the tough questions and enjoy the learning process. And I also published a 4-part series on permanent life insurance in November 2023 with Jeff Bernstein. So this episode, in addition to that 4-part series, is a good place to start your learning. All of Donny's links, including his website, his book, Get Wealthed Up, and his podcast, Wealthed Up, links to everything in the show notes. Without further delay, let's get right on to the interview. Hey everyone, welcome back to another episode of Beyond MD. I'm really excited to have Donny Mangos on the show today. Donny, it's great to have you here. We connected a little while ago. You were very kind to send me a copy of your book, Get Wealthed Up, which I read and really enjoyed. So I want to thank you first for that. And why don't you take a minute or two to just give us a bit of your background, because I understand that your journey, in fact, started in real estate. But tell us a bit about yourself.
Sure. Thanks. Yeah, it's a pleasure to be here. Long-time listener, first-time caller. I had a great experience in real estate. I've always been around high-value transactions. I believe in that's where the most of the assistance is required, and so I've really felt compelled to be the guy to assist, to guide, to educate clients. But I was a personal investor in real estate, still am, although much less these days, just with the economy and the instability, interest rates, LTV, which I know you've discussed in previous podcasts, all those reasons. But I helped clients build wealth through real estate for almost 20 years. Back when I started with hair and I've left it without hair.
That's how I feel about being a landlord as well.
Yeah, and for the most part, people are great and things work out really well. But the evolution away from real estate, there's a few reasons, and we could probably get into it today if you wanted to talk about that. It just hasn't, the conditions that I agreed to operate in changed on us, and I've had to adapt accordingly. So I didn't agree to that business model when I started becoming heavily into real estate, and when the provincial government started making some changes, rates, tenant laws, it made me rethink or revisit where I was placing my capital.
Donny, so actively now, are you still acquiring rental properties or no further?
I can say that if a deal came across my desk that was, too good to pass up, maybe I'd consider it. But I have not spent any time looking at real estate in the last 5 years. And as a result, if I don't feel good about it, there's no way I can talk to clients about it. I just don't like what has happened. So no, I'm not interested these days in real estate.
Okay. And just to let everybody know, we're not here to talk about real estate today, but we are here to talk about insurance. Donny, tell us how you started to get interested in permanent life insurance. And before you start, I will throw it out there that I understand in our physician community that this is a very polarizing topic. But one of the reasons I wanted to bring Donny onto the show is that he has had a policy for himself for many, many years, and he has been studying it carefully, and you're using it as a strategy. So as somebody who is using it, I wanted to get your perspectives because I thought they'd be valuable. So please go ahead.
Sure. So, experience with life insurance. I'm not really. So, life insurance for life insurance sake is one discussion, and I think we should have that for sure. I mean, and physicians, doctors, clinicians, there's really a need to have coverage. It's a noble consideration for who you're leaving behind. Flat out, like life insurance for life insurance sake is very important. I don't think of myself as an insurance like proponent or fan, really. I am a fan of strategy. I'm a fan of wealth strategy. And it just so happens that the most efficient route to achieve the strategy that I believe in the most, which is what you talk about in the book, The Money Mansion, it's accomplished through the use of a whole life insurance policy. It's just perfect for what I want to achieve. And there's lots of reasons why, there's a lot of good that comes out of this. So I'm happy to spend the next little while going through how and why Yatin, and I think if you're okay with it, we'll talk about how it maybe relates to you, and people can see live what it means to consider a strategy like this, and we can address all the issues that I believe I hear them as well from people that maybe misunderstand the value or the way to incorporate this kind of strategy with this kind of product into their life, because there's so much good from it.
Yeah, happy. Of course, we're going to dive into all that. I'm really curious, Donny. When did you first start to get interested in this strategy?
So I'm a business owner, just like you, just like all of our peers that are listening to this podcast. You're just thinking about your future. What could that look like? And for the longest time, I'm a son of immigrant parents, and they only knew one way to build wealth: investing with real estate. That's kind of how it was physical, it was tangible. They could understand that. And so I believed that for a long time, and I evolved. And I heard in one of your prior podcasts, there's novice and then there's pros. Sure, I was probably a novice on my way to becoming a pro in that regard. And then somebody in my life stopped me and just said, "Can I sit you down for a few minutes and have a discussion just about something that you may not have considered before?" And it was essentially what we're talking about today. It was a very small version of what that is, permanent life insurance. And this was my second cue. I missed the first one. Second one, I did not. And I was open. And I said, okay, I'm willing to consider this. What are you talking about? Speak to me in English. Show me what you mean. And I saw an opportunity to create wealth that sort of mimics the way I was doing it in real estate: appreciation, cash flow, tax efficiency. And my brain was able to absorb it then. So it was probably about 6 years ago now when it really clicked. And a business owner that I was, using my corporation, it made so much sense to adopt this strategy within my corporation because efficiencies were crazy when it comes to tax. It's just incredible opportunities existed that way. So that's how I started. And then this is when I was heavily into real estate. The real estate market, after that initial switch, sort of it rose a bit in Toronto, and then it sort of tanked. And as it tanked, because of what I had done with my own money mansion back when I started, I had liquidity. I had a long runway from which I could always use if I needed to for my business. I could use my money in two places at the same time. There was a lot of good that came out of me starting when I did, and now it's helped me so much in the last 5-6 years personally, but also professionally. That now this is the model that is the stronger foundation than a 100-story building has in our downtown core right now.
Okay. Everyone, you probably heard Donny mention a term, the money mansion. So this is Donny's term for the strategy that we are going to discuss today. And now, Donny, just dive into it. And I will let everybody know that throughout the episode, I do plan to not only pick Donny's brain, but to also challenge him on certain points. Again, this is just for a thorough discussion to make sure that we all get the most out of this. Donny, talk to me in English like I'm in high school. Just give me a brief overview on permanent life insurance.
Okay. So life insurance, what it is at its base level, it's a way to provide a death benefit to a surviving spouse. Originally, it was for a surviving spouse. So, you're a married couple, and I want to take care of my family if something should happen to me if I pass. So I exchange money called a premium in exchange to someone else willing to pay a death benefit in the future. And usually, death benefit is significantly higher than my annual or my contributions, my premiums. So I'm making a commitment with somebody, an insurance company, to pay a few bucks a year in exchange for a lot of bucks if something happens to me. Now, if I don't die, just like car insurance, you don't get in an accident, that money is gone. And for the most part, people that acquire term insurance, that's what they're doing. They're kind of buying car insurance, but on their lives. Something happens to me, you'll pay, but if nothing happens to me, the money that I paid is gone. And every year that I get older, if I look at the stats, I'm 1 year closer to dying. This is based on actuarial results, and this is simple math. Every year that I get older, I'm getting 1 year closer to dying. So on the term insurance thing, we'll talk about term insurance first, Yatin, so we can just set the boundary. Every year I'm alive is a bigger risk to the insurance company to pay that big number. So if I want $1 million to give to my wife, if something happens to me, next year it'll be more expensive for me to acquire that 1 year of insurance because I'm 1 year closer to dying. And every year that gets higher and higher and higher. Well, there's another option that you could use, permanent life insurance, and there's two varieties. I won't talk about universal life because it's not really fitting for this discussion, but the other one is participating whole life insurance. And whole life insurance is saying, look, for the rest of your life, based on who you are right now and what you're looking to achieve, you want $1 million death benefit paid to your wife? Fantastic. For the rest of your life, every year, you're going to pay this same dollar amount. And you're making that commitment at the same time. Day one, I will do this in exchange for that. That's basically what life insurance is doing. It's just saying in exchange for some money today and then next year and every year following, I'm buying coverage against an accident or a death so I can give money to my family so they can go and continue living their lives. They can go pay for the house. They can go pay for university, things like that. So there's solving a need.
And Donny, in your view, what are the key attributes of participating whole life insurance that make it potentially a worthwhile product to pursue a wealth strategy?
Okay, so I'm going to take a step back and answer this question. Yeah. It might be a bit longer than you had probably planned for.
Okay.
But okay.
Yeah.
So I do this talk. Here's an analogy, and this will make sense. So you've seen Back to the Future? Okay. Remember Biff the Butthead Tannen?
Yes.
All right. That's my dude. That is my wealth mentor. So in part 2, he, from the future, he's in 2000, whatever, 15 or something, and he grabs his sports almanac and he brings it back in the past. He gets in the time machine, goes back to young Biff, and he gives him this book. And in this book has all the results of these major financial or major sports events for the next 50, 60 years, whatever it was. So now young Biff is now looking at this thinking, I know exactly what's going to happen. I know how to profit from it all. I don't need advisors. I don't need research. I don't need educators. I don't need any of this kind of stuff. All I need to do is take this information, act on it, and I'll get everything I want in life. I'll get the fame, the riches, the girl, the hotel, the casinos, the respect, all that kind of stuff. And so I look at that and I'm like, that's all we need to be doing in our lives, really. Why can't we can't time travel, clearly. Well, yet. I will say yet. But what we can do is we can look forward and say, okay, I want some outcomes, some very specific outcomes. How can I build that into a book so that I can build my own almanac looking forward? So how do you do that? You could use contracts. You could use contracts that give you predictable outcomes and build your own almanac that way. Like, okay, something's here. If Biff is onto something here with how he approached his wealth building philosophy. Contracts create obligations. Clearly, like you have a mortgage, Yatin.
Mm-hmm. Yep.
You have a contract with your bank. You have an obligation to pay monthly. Obligations create certainty. Therefore, contracts create certainty. You know you're paying the bank every month. You know you're paying for your cell phone bill every month. It's going to happen because you signed a contract saying so. We understand how to use contracts in our lives, but we're not using them in the right way. We are someone else's cash flow. So I'm like, how can I create contracts so that I can get the outcomes I want, wealth outcomes, rather than investing or hoping or trying and researching and spending all that effort for someone who doesn't want that kind of path? Well, contracts do that. And the contracts that are going to have a predetermined outcome, death, exist. So why can't I repurpose that contract to achieve some wealth goals for me? And these contracts, whole life insurance, provide that conduit so I can build that almanac.
Okay.
Does that answer your question?
Yeah,
Kinda?
That does. So it sounds like this is a contract, and the way you described it, Donny, it seems like that contract in your mind gives you some predictability.
Exactly right.
And that's what you're looking for.
Yep.
And then maybe can you touch on, I covered permanent life insurance in a 4-part series in November 2023. So I do encourage everybody to at least revisit the first part of that series for a background. But Donny, you talked about the death benefit. Can you talk about a few other major features of this policy?
100%.
Things like tax sheltered growth, things like the cash value. Just touch on some of those things to round out our understanding.
Okay, so there's a few rights that come along with just buying a death benefit when you do so through a whole life insurance contract. Okay, so one is the cash value part of things is saying it's not, if you're on YouTube and you're looking for cash value and you're trying to figure out what I'm trying to say here, it's not a savings account, it's not a separate account. What is happening here is the cash value is a reflection right now, a moment in time. It's a reflection of the net present value of this contract that you have. So if I'm going to show you an example. I actually have numbers to show you.
Yeah, well, we're going to get into that. Yeah.
I'm going to pull it up because I think it'll be very relevant. You'll look at exact numbers and be like, I get it. But what it does in a nutshell is at any point in time, you are obligating an insurance company to pay a death benefit. And if you die, they're going to pay that big number. So at every point in time, the insurance company is willing to give you money to walk away from the deal, to give the contract back to them and walk away. So that number is the equity. It is the net present value of that death benefit in the future right now. So they always offer you it's like having a real estate pocket buyer. They're willing to give you the money today to walk away. And that number is the equity. Based on that equity, you could do a lot of things with it. You could give up the contract to the insurer and say, I'm done, give me my money back, and they'll give you that money. Whatever that amount is, and it's all math, they'll give you back that cash value. But they'll also let you use it as collateral, just like a house could, to go and get a line of credit based on the value of that, based on the cash value amount. So, and like real estate, as we've seen, it does go up, but it can go down.
Mm-hmm.
Death benefits do not go down. So the cash value does not go down. So if anything, it's more of a secure investment for a lender. It's more of a secure loan for a lender because they know that you're going to die at some point. This death benefit will pay out. They'll get their money back at some point. So whereas in a real estate transaction, you can probably get up to 80% typical financing if you needed to. You can get up to 90% if you use this contract as collateral. So that's one. That was a long one, but there's a lot of... That's a big part of why this whole thing works.
Okay. So the bottom line is participating whole life insurance, this policy, we're going to be making regular premiums, and there's going to be a death benefit that will, as long as we are paying those premiums, that death benefit will go up over time, up and to the right. And then there will also be a cash value in this policy that as long as we're paying those premiums, I understand the cash value will also continue to go up and to the right. The cash value, from my understanding, continues to grow. Will never exceed the death benefit, obviously. Now, I do want to maybe ask you a few questions that are technical before I get into your why, Donny, and then we can go into the numbers that you were going to pull up. But you mentioned that real estate can go down, but that this policy, as long as we are paying our premiums, cannot go down. My understanding is that the investments happening behind the scenes, they're not all that transparent, but these big insurance companies have been doing this for over 100 years. They have a track record. Tell us just, what do they tend to invest in? And two, could there conceivably be a crisis? Some things that I think about with what's happening in the world is a bond crisis, because I understand that there are fixed income investments happening. What if there was a bond crisis, and what if the insurance company couldn't pay me or couldn't pay my dependents? Can you address some of this right off the bat?
Sure. Okay. So the second part was if there's a crisis. The first part was can the value ever dip down? Is that what you said?
Yeah, I would just love to know.
Or what makes up the investment side of things, if you want to call it the
Exactly.
So in my world, this is not an investment, because an investment takes on some risk, and we're going to talk about why that risk doesn't exist. Market risk doesn't exist in the way that we understand it in this container. Okay, so I'm going to show you an example, Yatin, and I have an example of you contributing $100,000 annual premium to a contract, to a policy. Show you what the numbers look like. All right, $100,000 in your case buys a really big death benefit, and you're saying, I'm going to pay this every year. The insurance company collects your premium and then puts it to work. So what's happening in a participating whole life insurance policy? Participating means that you are sharing in the growth of that fund. Ultimately, there's a fund that the money goes into, and from that fund, they operate their business, they do investing, and they understand where this is headed. At the end of the year, when there's a surplus, they share some of the proceeds back with everybody who's in that fund. They participate with everybody in that fund. This is how this whole thing works. So every year they're very good at stats. You got to understand, these companies have been around for a long time, and they're very analytical, and they're very long-term focused. They're looking at what's going on. So they take all the premiums from all of us, put it into this big fund. And then they know they got to pay fees to run the business, staff. There's death benefits that are going to be paid out, and they know when they're going to happen. They have all this happening under the hood. From there, they also have leftover money that they know they're going to have, and they have to put it to work. They're obligated to grow that fund. They have to, because they have future death benefits they got to pay towards. They've got this long-term focus. So they go out and they find places to place their money. There is some investing. There's a lot of lending. And because they are a source of great wealth, big companies, infrastructure projects, governments are the ones calling on insurance companies asking to borrow money for a long term so they can go and deploy for these projects. Insurance companies do that. They also are people that lend to you and I if we want. So we talked about the policy loan kind of thing, or briefly, but if we wanted to borrow against the value of our contract, we could borrow from this fund as well. And we know what the rate's going to be. We could do that. So we're contributing to the growth of this fund. And when there's a surplus, that money is paid back to us as unit holders. And that thing is going to, whatever they pay back to us, we're not receiving it as cash in this strategy. You could, but we're not going to. That's going to buy more death benefit for us. So we're going to push our death benefit even higher. And the net present value of an even higher number is an even higher number. So whatever they're doing under the hood here in terms of all these individual decisions for these investments and placements, yeah, you're right. We don't know. We also I don't know that I care. Like their history is showing that every year they're not obligated to give back money to all the shareholders or all their participating fund holders, but every year they have. So they contribute money in advance. Like or at the end of the year, they do find they're in the surplus, and they do pay out these things called dividends. They're not really dividends. It's more return of capital or return of premium, but they pay out money to us. And it happens all the time. So I don't exactly know what is happening, but I do know that it's positive. And they're governed by like what they can and can't do. So there are rules in place, there are boundaries, there's liquidity requirements and all of that. The investment side of things is really protected. And I encourage anyone to look at all of these companies. I'll give you some big names in Canada. Canada Life, Sun Life, Manulife, Equitable Life. And there are several others. These are national brands, and they all publish what their participating funds do when it comes to dividends. So if you want to take a look at historical results, I encourage you to just do that on your own, and you'll see that every year these companies pay out money to their par fund holders. That's one.
So, Donny, in this par fund, has there ever been a point in history where this par fund has gone down, decreased
Never.
in value, something
No.
unexpected has happened?
Negative numbers?
Yeah.
No. Where they almost have like a margin call or so? No. And once they declare a dividend that year, and that pushes up your death benefit, which pushes up your cash value, it's yours forever. You can't diminish, that number cannot come back down. So it's not like a future year you'll see a lower death benefit. The only way that would happen is if you withdrew money from your account and lowered the death benefit. So only you can affect it negatively.
So we've already touched on a lot of mechanics and technical aspects of this policy. Donny, I would just love to hear your why. Why do you have this in your life?
Well, hang on. I want to answer the question about what happens if things go wrong, bond market crisis. Like,
yes, go for it. You go for it. Yeah.
So, yeah, you said this. So you're familiar with CDIC, and none of us seem really worried about what happens if you put money in the bank account. We feel covered with that, and we know that the banking system. Well, it used to be a fractional reserve. Now there is no fractional reserve. Now they can just decide that they want to multiply their assets and issue new money for the purpose of lending it out to consumers. And so there could be a big run on the banks, and liquidity could be really hampered that way. So they can take $1 in deposit and make it whatever they want and then lend it out. And that's a concern. On the insurance side, they don't have this. They have something different. So they have, all insurance companies in Canada are part of a group called Assurus, Assuris, Assurus. And that kind of acts like CDIC in that it guarantees your coverage, both death benefit and cash value. And the numbers for the top end numbers, when you exceed some, over $100,000 in annual premiums or in cash value, or $1 million in death benefit, they'll pay you up to 90%, or not up to, they'll pay you 90%. If your company fails and they can't place it into a different company, they will cover 90% of your death benefit or your cash value if you need that. The good on this is, since 1989, that was the last time we had an actual Assurance had to come in and step in and support this. That was the last time. And all of those accounts, all of those policies got moved over to a different company. So there was no need for Assurance to pay out anything. So it just doesn't happen. It just doesn't happen. But if it did, Assurance is there.
I would like to touch on your why when it comes to participating whole life insurance, because there is a tendency, myself included, we can get wrapped up in the mechanics of these products, but we don't think about why. Okay. So I'd love to hear your take.
I'm going to show you. Yatin, do you see this black screen with a tree?
I do.
Okay. This is your numbers, okay? So if you feel comfortable sharing, you're good online. But I am going to hide this for a second. So understand, this is an illustration. This is not a prediction. This is you putting in $100,000 a year for 10 years. I'm going to get to the why. This is the why. $100,000 a year for 10 years. That's $1 million. And I'm going to show you how you're going to pull out $2.7 million tax-free. So I talk about your corporation and how it's a bit of an efficiency trap, in that extraction is a problem for people that have corporation. It's a tax savings vehicle. It's amazing. You pay less income tax in a corporation than you would personally. However, you've created an extraction problem. And I believe you're going to ask me a question. I can see where you're going with this. What about investing in a corporation? Passive investing in a corporation is, quite frankly, if I had to broad stroke this, it's a terrible idea. The level of taxation that you experience in a corporation when you're acquiring passive income assets, real estate, GICs, bonds, you're paying 50% in the corporation.
Yes.
So eventually, when you pull it out personally, you're going to get rocked on tax again on the extraction from corporate to personal. Not a fan. And then there's a whole passive income clawback, which I don't know if you did an episode on, but it's crazy, this whole small business deduction that happens for.
Yeah. So in terms of passive income in the corp, totally agree. That is why I myself tend to not invest in things that pay interest inside the corporation. Tends to be a bit more growth oriented. And then yes, totally agree. The passive income clawback, if we have above a certain threshold of passive income, then the amount of retained earnings that we have that are eligible for that lower tax rate, that gets ground down. And so yes, we've
So
talked
tough.
about these concepts. Totally agree.
Yeah, and so these are traps that I call them. And then the worst thing is if you just do nothing because you're paralyzed, your money sits there, and inflation is going to destroy the wealth anyway in the corporation. And here's what happens if Yatin wanted 200 grand personally. Let's just say you wanted to extract 200 grand personally in a year. If you pull it out in salary, you got to pull out 307 grand in order for you to realize $200,000 net to you. If you did it through a non-eligible dividend method, right around 300 grand is where you got to pull out in order for you to see 200. If you do an eligible different dividend, which not everybody can do, you're going to probably lose about 80 grand ish to take out 200. And then of course there's a shareholder loan mechanism where you can pull money out from your corporation and you won't pay tax on that if you pay it back before the end of next fiscal year. But if you don't pay it back, shareholder loan not repaid becomes a deemed salary, and you're going to pay full tax on that bad boy. So why money management? Why am I talking about this? Why am I passionate about this? Why do I live this? Why do I share this? Because I want that almanac, and this gives me an almanac. I know what to predict. I know what to expect. I know what I can live with, and I know what I'm going to have when I'm done working in my business. This is my own way of providing for myself when I'm older. So I want the daily growth. I want the dividends. And I'll talk about the golden goose in a second, which is my annual cash flow that's coming in. Okay. So these are some numbers I'm going to show you. Your death benefit when you started the contract, when you put $100,000 in, and this is based on your age, Yatin, not moderate health, all that. This is not something you can guarantee to get. You'd have to apply for. But if for illustration purposes, this is what you're facing. $100,000 is buying you $2.7 million death benefit. $100,000 every year. And the way I've designed this example here is you stop paying in year 10. You pay 10 payments and you're not paying any more. Though it is a whole life insurance policy you're going to have the rest of your life, you're not paying anything beyond the 10 years. Okay, just to show you what it looks like. I don't know if you want to hide your age there, but you're a
That's okay. I'm turning 42 this year.
This is closest to age is how they do it. Okay, and this is an example of a bank loan rate when you do policy loans or you third party. When you take a loan on your cash value of your policy, it's 6.35%. This is just a guess. Honestly, my rates are lower than this personally at the moment, and it can fluctuate a little bit. It's usually just over prime if you wanted to go to a bank with a contract and say, I'd like a loan.
We'll talk about all this shortly too. Yeah.
Okay. And then I'll show you this. This is your numbers here. Yeah, this is you. 1 year in, you made $100,000. The cash value in this illustration that I've created, if you wanted to walk away after the first year, they'll give you back 93 grand.
So if I said, I put my hands up, I don't want to do this anymore, I walk away with 93K, down 7K after the first year.
And you had insurance for that year. If you died, they would have paid you $2.7 million. Okay. The next year, you put another $100,000 in. Cumulatively, you've paid 200 grand. Now you can see here, your cash value went up by 103 almost, as did your death benefit, the way that I've designed this here. So your death benefit started at 2.7, now it's at 3.2 and change. And because this went up, and this is the net present value of that number, and they know you're going to pay more money, this is what they're willing to give you to walk away. So already you're at what I call the bonus cash point in the book. Okay, so you've made more in cash value. You've increased your equity by more than you contributed. All right, fast forward to year 4 now. This is where you've contributed 400 grand in total, and your cash value is now $405,000, and your insurance is $3.8 million. Something happens to you. So far, so good?
Yep.
Okay, and I'll share this with you, Yatin. I'll give you the access to this, okay?
Okay, appreciate it.
After 10 years, you put up 100 grand in, $1 million in total. Every year, the number gets bigger between years. Every year, you put in 100, and it goes up by more than what it did last year, from year 3 on. So every year, this number gets bigger. Now you're at 1.2 is your cash value if you were to walk away. Now you wouldn't walk away. First of all, this would be taxable now because you made a gain. And we want to avoid taxes as best we can while being ethical and moral. But you see this here, your insurance is now at $5.5 million. It's climbing, it's climbing and climbing. And what we've done here is we stopped you paying. You're not paying anymore. Okay? And your cash value still goes up every year, even though you're not doing anything. And this has to do with, this is applying the current annual growth in the dividends this is an example with a specific carrier, and this is their numbers applied looking forward. They won't be too far off from this. That I have no problem assuring you. But I can't, like to the dollar, I can't predict that exactly. Directionally correct though, 100%. Okay, and then this keeps going forever, forever, forever. Now, why is this part right here? At age 65, Yatin, this is you. You are sitting on a cash value of $2.35 million, death benefit of 5.1. And what we have you doing here is you're going to start pulling money out. You're going to start extracting money every year as a loan, not as income.
Now, could that process be started earlier than 65 as well?
It could.
Okay.
Absolutely. So the earlier you start, so the longer you want it to last, something's got to give. So the amount that you extract every year is going to give, right? So I'll tell you what that looks like here. This is here, 42. This is you building a foundation. You're putting $100,000 a year. By your age 52, the policy is running itself. At age 65, you're going to pull out $149,000 a year, and you're going to ask me, what about interest? Yeah, you're not going to pay interest. Interest will accumulate with this. You're never going to pay interest or this loan back. Okay? So you're going to take out $149,000 a year, and it's a loan. Therefore, it is not taxable.
So, Donny, I do want to ask a few questions that are a bit more general before we get into using the policy. You mentioned that even after those 10 installments of $100,000 per year in this case, that the cash value continues to grow, and it's going to grow at a certain rate. What kind of rate can we reasonably expect?
Okay, it's a function of a few things. I don't know how to answer this question it's a percent, because it's not a percent. It's not an investment. What's happening is it's the net present value of that death benefit. So as death benefit grows, so too will your cash value. It's not a savings account. It's not an investment where it's going to appreciate that way. It doesn't work that way. It's a glimpse into what is the net present value of that death benefit, and it takes into consideration what's happening with the par fund, what's happening with how much money of yours do they have already sitting in their vault. How, like, when do they receive it? If you're making annual payments versus monthly, they've got more money up front. That all these things affect what you're going to see. So I wish it was a simple answer like 5% or 10%. It's neither of those things. It's a function of what is the net present value of that future death benefit in consideration for the payments made and the ones yet to be made.
I believe you mentioned on your podcast that there are good policies and then there are bad policies. Can you tell us what the key differences would be between a good and bad policy?
Yeah, so I think I call it your grandpa's policy. So I don't know if I'd say good and bad really. I'd just say they're achieving different results. Like the way that I described to your high school Yatin self about what an insurance policy is, that's kind of how, like, my parents had a policy talked to them and sold to them. Like, it was just, when something happens to you, this is what happens to your family. And so you're just talking about death benefit in exchange for some money. And it's got no consideration for what the policy is capable of doing. Growth, wealth, predictability of outcomes, like when it comes to those angles. Liquidity, huge. It's got no consideration for that. So a lot of times people are sold, or people are talked to about insurance policies that are just based on what is the cheapest premium I can pay for the highest death benefit. And when you do it that way, you're doing so in such a way that you're missing the opportunity to capitalize on what the contract's got built-in provisions for. So you're not going to get great results when it comes to cash value. And that's in my opinion is the grandpa policy. Like, that's the ones that we've inherited as us in the sandwich generation. Those are the ones we're seeing our parents have. And I would never design a policy that way. Though it benefits the advisor to design it that way, honestly, if you're talking about fees, they benefit when it's sold that way. I think I believe that the way to structure things, and the only way that I'll do it, is if I can create in such a way that it achieves some amazing cash and wealth goals for me while I'm alive. The death part's cool.
Why does the advisor benefit when it's sold that way?
Fees wise, I'm saying. So there is a part there where the way that you design the contract, the way that the advisor designs the contract, when we're optimizing for lowest premium for the highest amount of insurance, we're structuring it's an entire insurance contract based on like those mechanics, you're putting all this money into, without getting too specific on the contract itself, you're directing the money into one category of insurance, and it is the one that pays the most amount of money to the advisor in terms of compensation. Okay, like the ones that my dad has and my mom had, that's exactly what happened. They just very, very plain policy, wasn't optimized for growth whatsoever. The provisions were not great. They bought insurance, and when they bought insurance, they were rewarded for it. I wouldn't say it was unfair. Like I'd say the advisor probably got paid what it's all good. I don't really care what they get paid. What I care about is what does it do for me while I'm alive? And I believe a good policy is one that takes care of me while I'm alive. And the other side, I won't call it bad because it's just different. That's not really caring about me while I'm alive.
Donny, this is probably the right time to ask this questions, but why are commissions so high with this type of product potentially? I'd love your take on it.
I mean, high compared to what, I guess, is a...
Yeah, and I'll just caveat, the reason I'm asking this question is that commissions to advisors who put these policies in place, the high commissions are one of the things that make these policies somewhat polarizing and can deter people from exploring them. That's why I ask.
So I mean, I guess high is relative. I don't know. The numbers are, if you look at real estate, and real estate agents are under the gun right now, is 5%. If 5% is a number, is 5% of $1 million a lot of money for doing that one job? Maybe, right? It could be high to you. It could be high to me. And roll it with under that lens, I'd say, under that perspective. They're not paid pennies to find the right combo between the client and the company. They're paid well. Insurance advisors are paid well for that. But you're also getting paid for, the insurance company is getting a lifelong client now. This is not a one transaction and off they go type of deal. And they're front loading a lot of that effort with the, I guess, commission up in the first year. So a lot of the money comes from that. And maybe that's, the insurance companies decided that's what it takes to be competitive in this. I'm a long-term thinker as an insurance company. I know this client's going to be with me for 50 years. It's a one-time payment to this advisor. This number sounds fair in light of the fact that we're going to be working with this much premium over the life of this contract. So it's all front-loaded, I guess. I've never really faced that objection, quite honestly. Like, why? People don't even know how much money is being is being paid. I actually couldn't even tell you, without really researching every transaction, how much each deal or each placement rewards the advisor. But I can completely understand how people get up in arms about it. If someone says something online about real estate agents or investment advisors or insurance advisors getting paid a lot of money, it should cause you to consider, what is the motivation here? Who are they working for? Is this what's in it for me or what's in it for them? I would look at it that way, like it's value. What do I get? How do I win from this as the client? And if the advisor gets something for that, they should. They're going to be with you for the rest of your life too. But I care about myself more than I care about the advisor. I love the advisor, but I care about myself more than I care about you for this.
If for somebody who is considering a policy like this, what would you say are the must-ask questions to make sure that they're getting the right fit for them?
Yeah, so I have a little section at the end of this book where I talk about that, because it is a sticking point. Not all advisors are going to understand the way that you and I understand and the way your audience understands that there are options in how I can create these contracts. There are ways that I can structure this such that it achieves some of my high cash value goals. I want liquidity. It's very important to me. And I would ask that question. I would put an emphasis on understanding early cash value. I'll make a lifelong decision, but I don't want to be penalized. Like I don't want to suffer from changing my mind or life circumstances changing me or forcing my hand and changing what I just did. And now I'm stuck on a policy or in a contract where, just like my bank, I'm paying a lot of money each year and I'm not getting to experience the benefits of that contract. So the cash value component's a big one for me. I want to know that the liquidity is there. I can access the money whenever I want. And if I want to go nuclear, and then if I sold this, I'm not going to lose a lot of money. In fact, I want to come up ahead. in this swap. So I would ask questions about cash value for sure.
Okay. You mentioned in that illustration there was a term "in the money." What does that mean?
Okay, I'll go back to the illustration. This is how I speak about it. All right, this is not technical that way. This is your friend Donny calling it this. So in the money point, the total CSV first exceeds the total premiums paid.
Gotcha.
So to me, it's your money's fully liquid, and you're ahead now. And I can show it to you again on this little thing here. Every dollar
I saw
put
the
in,
transition point. I think it was year 4.
yeah, right here.
Yeah.
Do you see my screen, Yatin?
I do.
Yeah. So $400,000 is what you've cumulatively put into this contract, and you're at 405 in terms of cash value.
Okay. Put in 400 at 405,000 of cash value in the money. Okay.
You're in the money.
Okay. So Donny, now that we have taken some time to understand this product and why, so to sum up your why, we're both incorporated, and essentially you are looking for a vehicle, a strategy where you are essentially going to be guaranteed to grow your wealth. This strategy is not going to be subject to the whims of the market. It's a long-term strategy. It's also a tax-efficient strategy, and it's also liquid. And
Exactly.
we're going to touch on some of that liquidity now. Talk to us about how ethically, legally, we can use these policies. Maybe it's to spend on monthly expenses. Maybe it's an emergency that comes up. Just talk to us about how we can do this.
Here you are, Yatin. You're looking at expansion. So you've got this policy set up, and you weren't sure that you were going to do this, but you started putting your money into this policy because you wanted to buy the death benefit, you wanted to buy the coverage, you wanted to have a place that is not your GIC or whatever, that's just going to deplete the value of your reserves or your retained earnings. So it's just sitting there. You're going to just change where it lives, and you're putting in this contract. So now while you're figuring out your business and the money's just accumulating, and then you realize, I wanted to expand. I wanted to buy this building. I wanted to move my office into this building and do this, or I wanted to bring on staff, or whatever the case may be. And a lot of business owners just wait for that moment to happen, and then they have cash sitting there. Now they can use that money to go and spend, or to invest in a business, or to cover a shortfall, whatever. This is saying what you did was you put your money to work while you were figuring stuff out. And when you need access to money, you've never given up access to money. What you're going to do is, instead of withdrawing money from your bank account, you're going to issue a loan to yourself, a line of credit, against the value of an asset that is growing. So you still maintain the liquidity. You can still fund that expansion. You could still hire that new team member. You're just going to do it a bit differently. To me, I talk about balance. So in your business, everything we do, we get an invoice, we pay it, the money physically leaves our control and it goes to that vendor. 50 grand for a new machine, gone. 50 grand is out the door. That money will never grow for us anymore. And then we wonder why we're constantly on this treadmill. So I introduce balance. What I mean by this is, through this structure, you could have deployed that 50 grand into your business through your own money mansion. Do something good with your money, put it somewhere where it's going to grow. Before you do something bad, which is spend. And when you do spend, you spend from borrowed money, not from your money. So your money continues to grow. It's a simple concept. You want to compound your money. This is how you compound. You spend from somewhere else and you borrow. So you grow from your money and you borrow from someone else to spend. You're doing two things with your money instead of just the one thing, getting rid of it. Okay. So you've created a loan, but you increased your cash, you increased the value of your contract by more than what you're borrowing. If all you do is just play this game where it's a game of chicken, you're just between your assets and your liabilities, you're going to win, because at some point you will die. This policy death benefit that's getting bigger and bigger will pay out all these loans. You're going to come out ahead. You're going to leave a lot of money to your family. Okay. So there's a lot of that. Anyway, so you could access money through your corporation, through the policy that your corporation owns.
Okay. So to sum that up, corporation owns a policy. Let's say I see an investment opportunity done through my corporation. I can obtain a loan using the cash value of my policy and that loan comes from potentially the same insurance company, but whatever I have in that policy, that itself is not touched. You're saying that continues to grow
Precisely.
and compound. And how long does it take to get this loan? Is this days, weeks? How
Depends.
easy is this?
The most efficient way of doing this, once you're comfortable, like once you understand how the mechanics and you're like, I got this. It's just like a HELOC, for example, on a property. You can walk into any lender, your lender, and say, here's my contract. I want to collateralize this. Now you've got one at, we'll call it a major bank. I don't want to name any banks. You go to a major bank. This is what I want to do. They'll institute a line of credit. It takes minutes probably for you to move money back and forth if you wanted to. If you're going to do it directly through the carrier, a few days, and the money's in your account.
The challenge I have, and I'll talk out loud here, Donny, and you can help me clarify my thinking. The challenge I have is wrapping my head around the loan and the interest on that loan, because that loan and the interest, it'll have to be paid back, right?
Yeah, it will.
Yeah. So I struggle with that a little bit, but I realize that whatever that policy has and whatever that's growing inside that policy, that compounding process with this maneuver that we discussed, that compounding process has not been interrupted, right? Whereas if I had a portfolio on the side, not policy related, and I had another investment opportunity, I would have to potentially extract from that portfolio and interrupt that compounding process. Am I thinking about this correctly?
You're 100% right. So
Okay.
It's a withdraw. So you stop the growth and then you've reduced it. And you've probably created a taxable event in that withdrawal.
Okay.
Right? So you've done a couple of different things that are working against you when it comes to growth. And a lot of times it's what you just described. The word debt freaks people out. And so they don't give themselves permission to use this through the debt angle. But to me, the growth is unlocked by freeing yourself to allow yourself to use debt. If you can do that and be comfortable with it, understanding that at any point in time, if you decide, I don't like the debt, and you should be okay with it, but if at any point in time you're freaked out by it, you could always go nuclear, sell the asset. You will never have more money borrowed than you have in equity in that same contract.
Okay, next question. Maybe I'm approaching a bit of a gray area here, but let's say that I have expenses that are related to an upcoming personal vacation, and let's say I retire and I want to begin to fund my lifestyle personally. What if a corporate policy was used as collateral for a loan that was going to be used personally? Is that fair game, or is that gray area, or is that CRA audit? What are we looking at here?
That's a great question. And it's hard to find info on that, isn't it? If you've been down this path.
Yeah, I get varying opinions.
Yeah.
And so I'm always looking for perspectives, especially from somebody who has a policy like yourself and is using it.
Yep. So this is pretty common. So it happens. What you just described, shareholder of the corporation, provided it's on your life. So your corporation has an policy on your life because you're pretty important to your corporation, I would say. And then Yatin says, I'm going to take this, I'm going to ask the corporation's permission. The corporation says yes, because it's a board of one and I am the board. And they say, I'll let you borrow this policy. Go over there to your lender on the personal side and you have our permission. In exchange for something, okay, you go over there and you can use this as collateral, provided you meet in certain criteria, and you go get a personal loan using this corporate asset that you are borrowing. And now you've borrowed money personally in your retirement. This is actually what I'm demonstrating in that screen share to you. In your case specifically, you're doing this to the tune of $149,000 annually on the personal side, through a major lender, anyone you want. And you're not going to pay interest on that. 150 grand-ish, personally borrowing. You're living the life. You're going to Japan. You're doing all the things you want to do. And you are just letting that loan accumulate. Because at the same time, your death benefit keeps getting higher and higher and higher because of your participating fund thing. It's continuing to buy more and more and more death benefit for you as the years go on. Even though you're not contributing to it, it's contributing to it on your behalf. So it's building up. So now it's a race. You're pulling out a lot of money from like personally,
Mm-hmm.
and you have to there's a certain structure, and I won't get in trouble or implicate myself by saying exactly what needs to be done, but a tax lawyer, an estate lawyer, a corporate lawyer would know exactly what to do to show you what you need to document and how you need to facilitate this borrowing of your corporate asset to achieve these personal goals into retirement.
Okay, so what I'm getting here is that if done the right way, I's are dotted, T's are crossed, that this is a strategy that is legal, can be done.
There's loads of publications from all the insurance carriers on this as well. There is precedent. It's not a secret. It's just not openly available to find information about online for some reason. And for that reason, I also don't want to be implicated in any.
Fair enough.
But I would say, Yatin, we can talk about this offline as well. But there are opportunities for you to do just that.
Yeah,
Okay?
and I do want to also bring this up. I don't believe that for people who have policies like this, I don't believe that what we just talked about is going to be your only bucket in retirement. Donny, I do want to hit on a point here. I don't think we've talked about this before. I don't believe this is an either or. This is a bucket. What is your take on that? Do you agree?
So yeah, there's some books that are written that I think call this thing exactly what it is. It's called an and asset. It's not an or. If you believe in if you want to invest, if you have the time, like the gentleman that was talking about owning 115 unit buildings in Alberta on one of your past podcasts, he loves investing in real estate. He loves the art of the deal. He loves locating, and he wants to be an active participant in the growth of his money. You can still do this. And I believe he's got permanent insurance policies like this as well. And I know you do a lot of ETF and fund watching. You might want to do the same thing. And what you're doing is you're putting your money in a place where you know it's going to grow. You are not taking any risk on that. It's going to grow. And if you want to challenge yourself by trying earning more money through investing, it's going to come at a cost, the cost of interest. But if you can't exceed the cost of interest, maybe you shouldn't be investing to begin with. I mean, seriously. And if you do it in that capacity, if you do it in that format, the first thing is the money management. First thing is the strategy. First thing is the policy. If you started borrowing to invest, well, now you've just created a tax deductible interest expense as well. So if you're going to, there's opportunity to optimize.
Right.
So I think it's not an or at all. It could be its own thing forever for somebody. It's simple. It's boring. You'll never get excited about it the way I am, but you know that it's going to work out. It's an almanac. It's telling you what's going to happen in your future. But if you want to get investing, you could do both.
Now, let's say the cash value in the policy is being used as collateral for a personal loan, and let's just say that personal loan was obtained at a very low rate of interest, lower than what may have been possible for a corporate loan. That creates a bit of arbitrage there that maybe could raise some eyebrows. I've heard that this is potentially a gray area and potentially expect to cough up a few more fees here. Do you have a take on this? Maybe I'm getting too into the weeds.
Yeah, I don't think I touch on it. I actually don't think that'd be a problem, because unless you document that you were able to, you couldn't get that rate on the corporate side, 15 years ago after you started this, how would anybody challenge you on that? One, but you do need to show that there is the corporation that you're borrowing from, your corporation, needs to benefit in some capacity from allowing you to borrow a corporate asset for personal gain. So there is a charge or the fee that you'd want to contribute from yourself to the corporation, a fee in exchange for allowing that right to borrow. And that is a little ambiguous. Well, on this call, it will be ambiguous. You have to be careful about what you decide you're going to pay from yourself to your corporation for the right to borrow that policy to use as collateral personally. That's a lot of words.
That's okay. That's okay.
You got that? Okay.
Yeah. Donny, maybe just, if you can, share with us some gray areas, some behaviors to avoid when using a policy like this. Where can we get into trouble?
Really, this is such an incredible vehicle to achieving wealth and optimization for taxes that the CRA, has always tried. It's been a few major revisions to the Act, the Income Tax Act, where they've sort of blocked what you can do in a corporation. So at one point, or in a policy, at one point, you could have taken a few $1,000,000, brought it into an insurance policy, made one payment, boom, and then just live off of that, pull out money, extract all you want without, and as it's growing, you're not paying taxes. That's been plugged. So there's as long as you treat it first as an insurance contract, which you would, you're not getting into trouble. But there are a lot, like all these insurance carriers, based on what you're asking for in an insurance policy, they won't let you cross over into the other side of getting in trouble with the CRA. They will sound alarms. So you could misuse it, but there's a lot of protections in place to prevent you from accidentally misusing it and getting in trouble with the CRA.
Okay. So what you're saying is fund this policy, ramp up that cash value, do an IFA, pull that all out personally, go party on a yacht. As long as we're not doing that, you're okay.
You probably would be okay in that case. You shouldn't do it. But
I'm trying to challenge you where I can here. I'm not doing a very good job.
I just don't. There's. I've looked for many reasons why not. Yeah, in all honesty, like in complete sincerity, I've looked for so many reasons why not. And I was you before I was me. And I'm like, yeah, what am I missing? Like, why wouldn't people do this? Why isn't this more mainstream? It's because it takes people like you and I an hour to talk about this. And this is not our first hour, right? Like it takes a long time to fully understand and satisfy all those questions. And we're right to be skeptical. We're right to be timid, right to be scared. But I can't find, there's not a lot of reasons why not beyond you just can't. Like physically, you can't qualify for insurance. That's a big component because you have to apply. You have to have the health. You have to have a reason to be insured.
I want to make my case though, Donny, for why this may not be a good idea for somebody in a certain stage of their life. So I'm looking at my colleagues who start practice and they have mountains of debt. And that's a very up and down time in life when you're raising family, you've got debts, maybe you've got a new mortgage, you've got a lot of financial commitments. I could see a policy like this being a little bit problematic because let's say you sign up, you've got a commitment to pay these premiums, and then all of a sudden, there's too many financial commitments. You can't pay these premiums. I see that as an issue.
I don't disagree. You cannot enter into this contract unless you are fully committed and you're able to continue to fund this contract. You got to go, like, so in your case there, we showed you an example of you doing it for 10 years, okay, based on your numbers. It could be that this is called an offset. That time is called an offset when your dividend growth and your contract growth offsets the premium cost each year. You could probably do that. You personally, in that example, you could probably set it off at around 7 or 8, year 7 or year 8. So somebody who's thinking along those lines, they've got to think you have to fund this thing for 7, 8 years. You have to in order for this thing to make sense. And if you're doing it for that short a window, the cash value is not going to be great. The benefits aren't essentially going to be there. So this is not for everybody. You're absolutely right. It's not for everybody. You have to be able to be responsible. You have to be able to cover these annual payments because you're going to have to be qualified against your ability to fund the contract. And an insurance carrier who's underwriting you, if they sense that you've got a lot of debt and you don't have an opportunity to fund this with money, they're going to turn you down anyways. And the last thing you want to do is be turned down for insurance. It's not a good look for future insurance applications. So I would say, yeah, you're right. It isn't for everybody, but it's for a lot of people, including my daughters, who do this as well. And I know that you're aware of that. Like my kids operate this way. And they've been doing it now. They're making their 4th payment. Well, I'll make it this week. So for like the 4th annual payment. So this is a wonderful strategy for a lot of people, but it changes everything you know about working with money. And it involves you being comfortable with the word debt because you got to look at it differently than you have been looking at it.
Donny, is there anything about these policies and this strategy that we haven't covered that you want to cover today? I'll leave it at that. And if not, I want to give you a chance to tell us about your book and your podcast and anything else.
You are a sweet, sweet man, Yatin. I know you got an audience listening to this, and I'm thankful for the time. This has been a long chat about something that I'm very passionate about. I do believe in, for lack of a better word, literacy when it comes to finance. I just feel like there's a lack of that. I take it personally because I'm a dad and I'm trying to raise two strong daughters who are going to be independent, and not just independent, but are going to have a good life. Everything I do is with lifestyle in mind. It's not about spreadsheets for spreadsheets' sake or looking at green numbers. I want Yatin, I want Japan for 2 weeks in March. Seriously, and that is the motivation for behind all this. And I want that for everybody. Toronto and Canada are expensive places right now, and a lot of things, a lot of noise, a lot of distractions. Affordability is, really crushing right now. If we keep going, if we keep following this path, I think it's been a degrading last couple of years, last couple of decades. When I look at what my dad was able to accomplish as a dishwasher and then a butcher and then a restaurant owner versus what's required now to sustain the kind of lifestyle he led, I don't like the trajectory of where we're headed. And I believe that the system is doing what it's doing to us because we're not putting up a resistance to it. I believe there's other ways of achieving some amazing outcomes. So I don't want to get all political. Just know that there's ways to do things beyond what we've been doing. And I just want to spark curiosity. So I would say a good first step is have a discussion with, or have a read of Get Wealthed Up on Amazon, Kindle, audiobook on Spotify, all that. It's available if you want to invest 2.5 hours of your time listening to me talk about this. And it's a lot about the how, which if you're a doctor, you want to know how. I get it. I want to know how. That's the how. And then you start considering ways to fit into your life. I have a podcast, which I'd love to get you on, Yatin. Called
anytime. I'd love to sit down and chat with you. I appreciate that.
Called Wealthed Up with Donny Mangos, available everywhere as well. And if you want to visit me, go to wealthedup.com, and I'm happy to book a chat with you. Just tell me that you heard me on Yatin's Beyond MD podcast, and there's no charge. I'm just happy to have a discussion about you and know more about you and see if this is a good fit for you. It isn't right for everybody, as we described, but it's right for a lot of people. And at the very least, if it's education and if it's a discussion that sparks curiosity, I'll take the win.
It's been really fun chatting with you, and it always is. And great job with your book as well, and your podcast, okay? Thanks for making time for us today. In case anyone was wondering, I myself at this point in time do not have a permanent life insurance policy, but you know me, that does not stop me from learning about these topics. Thank you as always for joining and continuing to support Beyond MD. In a few weeks' time, I look forward to bringing you the next episode, which will dive back into charitable giving, and we will be talking about how to make this process more meaningful and some of the evidence behind how being charitable can lead to a happier life. Feel free to reach out anytime, whether it's feedback on this current episode or what you would like to hear about on future episodes. You can email me at yatin@beyondmd.ca. I always look forward to hearing from you, and until next time, stay well, stay savvy.